Silver is trading at $66.26 per ounce right now, and in the next 48 hours, a single government data release could change everything. Not tomorrow. Not next week. Tomorrow morning. The PCE report drops, the Federal Reserve's preferred inflation gauge, and what it shows could trigger one of the most significant moves in the silver market we've seen all year. Most people watching silver right now are looking at the wrong thing. They're watching the price. They should be watching the pressure building underneath it. Because what's happening beneath the surface of this market right now is not normal. Stay with me through this entire video because by the end, you're going to understand something about silver's positioning ahead of this PCE release that Wall Street analysts are not explaining to retail investors. And that gap in understanding? That's exactly where generational wealth is either built or permanently lost. Credibility build. 0:30 to 2 o'clock. Let's establish where we are. Silver at $66 is not a random number. It represents a market that has absorbed months of Federal Reserve pressure, a stronger than expected dollar environment, and still refused to break down. That's not weakness holding at this level. That's structural demand refusing to yield. Consider what happened the last time PCE data surprised to the upside in 2023. Silver dropped sharply in the 24 hours that followed, and then reversed completely within 2 weeks as the market digested what that inflation reading actually meant for real assets. Investors who panicked in that window sold into the hands of institutions who understood the macro picture. Now here we are again, pre-PCE, pre-Fed decision environment. And silver is sitting at $66 with open interest on COMEX still elevated, registered inventories still under pressure, and industrial demand from solar, AI infrastructure, and semiconductor fabrication running at record pace. This is not a coincidence. This is a setup. Most people don't understand this. 2 o'clock to 3:30. Here's what most people fundamentally misread about silver right now. They treat PCE like a simple on-off switch. Inflation hot equals bad for metals. Inflation cool equals Fed cuts equals good for metals. Clean, neat, binary. But that's not how this market actually works anymore. The relationship between inflation data and silver has become far more complex, because silver is now operating simultaneously as a monetary metal and an industrial commodity and a structural deficit. Those two identities respond to macro data differently, and when you layer them on top of each other, you get a market that can move violently in either direction after a data release, and then correct just as violently as the true fundamental picture reasserts itself. The investors who win in this environment are not the ones who react fastest to the headline number. They're the ones who understand what the number means for the 6-month trajectory of monetary policy, dollar strength, and real industrial demand. That's a different calculation entirely. And most retail participants never make it. You're making it right now. That already puts you ahead. Build tension, 3:30 to 5:30. Now let me tell you what's actually at stake tomorrow. If PCE comes in hotter than expected, above the consensus estimate, the immediate market reaction will likely be a silver pullback. Dollar strength, rate cut hopes fading, risk assets under pressure. That's the surface level read. And that's what weak hands will react to. But here's what that scenario actually means underneath. Hot PCE means inflation is not dead. It means the Federal Reserve's tightening campaign has not fully worked. It means the purchasing power of the dollar continues to erode, slowly, steadily, relentlessly. And throughout all of human monetary history, that environment has been the foundation on which precious metals build their most powerful bull runs. The fear you'd feel watching silver drop $2 or $3 after a hot PCE print? That fear is the exact mechanism through which patient capital accumulates positions before the larger move. Now flip it. If PCE comes in cooler than expected, if it signals that inflation is decelerating meaningfully, the Fed pivot narrative reignites. Rate cut expectations accelerate, the dollar softens. And silver, already at $66 with industrial demand structurally embedded underneath it, could move fast and move hard to the upside. Both scenarios, hot print or cool print, ultimately point in the same direction for silver over the next 6 to 12 months. The difference is the path. And the path is where most investors get shaken out. This is the moment where understanding the structure of this market becomes the difference between holding through volatility and making a catastrophic timing mistake. Layering supply, demand, and the bigger picture, 5:30 to 7:30. Step back further and look at what silver is actually doing in the global economy right now. The Silver Institute reported a structural supply deficit that has persisted for multiple consecutive years. Mine supply cannot keep pace with the acceleration of industrial consumption. Solar panel manufacturing alone is consuming silver at a rate that would have been unimaginable a decade ago. And that demand is not discretionary. It's embedded in government green energy mandates across Europe, Asia, and North America. Layer on top of that the AI infrastructure build-out, data centers, advanced semiconductor fabrication, high-frequency electronics. Every layer of the artificial intelligence economy runs through silver, not symbolically, physically. The metal is irreplaceable in the conductivity requirements of next-generation chips and server architecture. And while that industrial demand has been quietly, relentlessly consuming physical supply, central banks around the world have been accelerating their accumulation of hard assets. Gold gets the headlines. But silver is the asset that retail investors and smaller sovereign funds can actually access at scale without moving the market against themselves. At $66 an ounce, silver remains deeply undervalued relative to gold on any historical gold-to-silver ratio analysis. The ratio sits at historically elevated levels. When that ratio compresses, and history shows it always does, silver's percentage gains dwarf gold's. That's not speculation. That's 4,000 years of monetary history speaking. Smart money veers weak hands, 7:30 to 9 o'clock. Here is the hardest truth in any commodities market. The investors who build real wealth in silver are not the ones who buy after confirmation. They're not the ones waiting for the breakout to be obvious, for the headlines to be undeniable, for their neighbor to bring it up at a dinner party. By that point, the move has happened. The opportunity has transferred from patient hands to impatient ones in reverse. Smart money positions before PCE, before the Fed decision, before the mainstream narrative catches up to what the data has been quietly signaling for months. They position when there's still doubt in the room, when there's still fear in the price. When holding feels uncomfortable, weak hands do the opposite. They sell into pre-data uncertainty. They panic at a $2 drop. They confuse short-term volatility with long-term thesis destruction. And in doing so, they hand their position and their potential gains to the institutions sitting on the other side of that trade. Which side of that trade you're on tomorrow will depend entirely on whether you understand what this PCE report actually represents inside the longer macro story. Risk acknowledgement, 9 o'clock to 10 o'clock. Now, in this matters, none of this is without risk. Silver is a volatile asset. It can move dramatically in short periods. A hot PCE print could trigger a pullback that tests psychological support levels and feels deeply uncomfortable for anyone holding a position. Momentum traders could accelerate that move. Margin liquidations could exaggerate it. There is also the possibility that the Fed finds a way to hold rates higher for longer than the market currently anticipates, which would sustain dollar strength and cap silver's upside in the near term. That scenario exists, it has to be acknowledged, and geopolitical risk, while generally constructive for precious metals, can create correlated sell-offs across all assets if a liquidity crisis emerges. That's a tail risk, but it's real. What separates informed investors from the rest is not the absence of risk. It's the clarity to see risk within the context of a larger thesis, and to hold that thesis with conviction when the short-term noise tries to shake it loose. Powerful ending, 10 o'clock to end. Tomorrow morning, when that PCE number drops and the market reacts, I want you to remember something. Every great wealth transfer in history has happened inside windows of confusion. Not after the clarity, inside the chaos. Inside the moments when most people didn't know which way to look. Silver at $66, on the eve of a Federal Reserve defining inflation print, in the middle of a structural supply deficit, with AI and clean energy demand accelerating underneath it, this is one of those windows. The question isn't whether silver moves from here. History, data, and the fundamental structure of this market all point to the same answer on that. The question is whether you're positioned before the market figures it out, or after. So here's what I want to know from you. Before that PCE number hits tomorrow, are you holding your silver position, or are you watching from the sidelines? Drop your answer in the comments. Holding or watching? Let's see where this community stands before the number drops. Because in 48 hours, this conversation gets a lot more interesting.